is Financial Thought Exchange of the CFA Institute Research Foundation, where you learn from the leading thinkers in finance. I'm your host, Lotta Moberg, and my guests today are Petter Kolm. Petter is a clinical professor at NYU Courant, where he directs the Mathematics in Finance Master's program. His expertise spans machine learning, portfolio theory, and systematic trading in both academia and industry. I also have with me Gordon Ritter, a partner at Ritter Alpha LP and an adjunct professor at NYU Courant, Columbia University, and Baruch College. And Gordon is a leader in systematic trading and portfolio optimization. Now, they are both here as contributors to our publication about AI in asset management. And they wrote a chapter, a very interesting chapter, great read, very educational. The co-author, Igor Halperin, is not here, but he was a big contributor to this, obviously. So first, thank you so much for being here, and thank you so much for the contributions to this publication.
It's great to be here. Thank you for having us.
I'm really looking for this conversation, and your chapter is about reinforcement learning and also inverse reinforcement learning, something I'd not heard about before. So we'll learn about those two topics, and note also that this is the first out of two conversations on this publication. So after you listen to this episode, make sure that you click on the next one to get the full scope. And of course, we recommend that you also pick up the publication and especially read their chapter, which we'll have linked down below in the description. So let's go, and let's start with a little bit of an overview. Now, a lot of people think about AI, and everything that sounds a little bit technical is AI, and there's certainly a connection here. But just in terms of reinforcement learning, that's something that certainly I heard about quite a lot before, a few years before ChatGPT came on the scene and things like that. So maybe just either of you can start off by just giving the overview of the difference, what we're talking about reinforcement learning as opposed to any of the LLM bots out there that people may be interacting with.
So maybe I'll go first, and then Gordon can chime in a little bit because both of us, well, we have worked on this together for many years. We can offer slightly different perspectives on this, but bigger picture, reinforcement learning is about making a sequence or planning a sequence of decisions over time by observing an environment. These algorithms are trained in a way that they maximize some criteria, often referred to as the reward. And of course, thinking in those simple terms, it's not unreasonable to say that it's been around for quite a while. Reinforcement learning is not something that is new. There have been a number of publications over the years. Many of you know about the Sutton-Bardo textbook on reinforcement learning. That's something that often people come across. That's quite interesting. But perhaps what is new here is some of the use cases that we're seeing in finance. And I think we're going to get into that a little bit more detail by why is reinforcement learning suitable for finance or financial trading.
Yeah, that's a great intro, Petter. Yeah, I would add, reinforcement learning is certainly not new, like deep learning itself, right? So already in the 90s, reinforcement learning and deep learning were both, rather well-developed fields with hundreds or thousands of publications and graduate level textbooks. I think what's really dramatically blown up just in the last 5 years, I would say, is the computational ability to actually solve these problems at scale and to train these models in extremely efficient manners using mind-boggling numbers of parameters. So I personally started thinking about applying reinforcement learning to finance in 2016, and I was inspired by the Sutton and Bardo book especially, and Petter and I together had already been thinking about multi-period strategic planning models together, and it struck me when I read Sutton and Bardo and related publications, just how they were kind of solving the same problem, right? And we were coming up against the same issues that the Hamilton-Jacobi-Bellman equations for the, either the models were not Markov or the Hamilton-Jacobi-Bellman equations didn't admit any explicit solutions, or the problems were discrete. And it struck me around that time, 2016 or so, that reinforcement learning was really the perfect toolkit to solve these things. And we wrote our first paper on that in 2017.
Right. Yeah, we won't probably have the chance to go through what all of those kind of equations mean, but it's really making the point that there's a lot going on here, and there's a lot of like complicated things that when a reinforcement learning is applied, right, you can solve a lot of things that wouldn't have been possible otherwise. Just in terms of the basics of, so somebody is listening to this, doesn't know anything, kind of AI versus machine learning versus reinforcement learning. I use ChatGPT, they will say. And what's the difference? Kind of how can we explain that that's not the kind of process we're talking about now that is going on in the kind of predicted chatbots that people may be coming across when they think AI? They'll be thinking AI when they listen to this conversation, right?
Yeah, I
Yeah,
mean, actually, a ton of reinforcement learning was used in producing those chatbots. We can't see what goes on behind the hood or under the hood and behind the scenes at places like Anthropic. But, for example, OpenAI has released white papers on earlier versions like GPT-3 and 4. And yeah, I mean, it's the main training method that they use is a very, state-of-the-art implementation of some form of PPO, proximal policy optimization, which Petter and I also applied to option trading in a 2020 paper.
If we step back from a bigger picture perspective, it might be useful to give a concrete example of how reinforcement learning might now enter into decision making in finance as a sequential, as we call it, a sequential decision making problem, right? Imagine, for example, that you decided to trade 10,000 shares of Google. You're obviously not going to go to the markets and buy that immediately because that's going to incur a lot of price impact. So what you typically do is you're going to be trading that over time. So now you need to decide based on some objective that you might have, how you're going to plan that sequence of decisions of your trades, and how you're going to spread that out over time. Of course, a problem of this kind has many classical solutions that relies on stochastic control techniques. But reinforcement learning turns this into a data-driven learning type of problem. And I think that to what Gordon was saying earlier, it allows us to address problems that previously we couldn't necessarily. We have the compute to do that today, to scale it at larger scale, and we also don't need to just rely on problems that do have, in some sense, not closed form solutions, but they have properties such as that I can derive value functions, for example, in closed forms. Reinforcement learning allows us to learn this directly from the data that we observe in the markets.
Yeah, I guess also I would add, one of the things I love about reinforcement learning is that it's one of those areas that everyone can grasp, like to varying extents. But I can explain it to my mom because it's literally the same process by which children learn. Animals learn. Essentially, it comes down to like touching a hot stove or the Pavlov dog experiment, right? So reinforcement learning systems learn from experience. And just like for example, a gazelle when it's first born and learns to walk, it has the muscles, it doesn't have the experience, and it tries different muscular combinations until it can put them together and walk and run. And that's literally what's going on inside reinforcement learning systems. Learning by trial and error. Anyone can understand it.
Yeah, that's very helpful. So maybe just cover then, like, how is that different, the learning from experience part, as opposed to when we think about like supervised learning, that kind of process of learning, what would be the difference there? Maybe that would be helpful too.
Yeah, so the main difference is in reinforcement learning, we have an action space, and we're learning how to select actions from the action space. And we're learning to select actions that maximize a kind of a long-term good or long-term benefit, right? So in chess and more generally in life, sometimes we have to pay a short-term cost in order to position ourselves for a long-term benefit. And in investing as well, that's a very well-known idea. You pay a short-term cost to enter a fund or enter a trade, and then invest for the long term. And so reinforcement learning systems have this notion of multi-period returns built in from the start. There's a return in each period, of course, but the agent learns to choose their actions from a menu of available actions in such a way that they maximize a long-term sum or some other long-term function of many such rewards over many time periods.
Yeah, that's interesting. So it's like in life, you're kind of touching on the exploration versus exploitation aspect, right? In the sense of like the time aspect, like you said as well, in terms of if I would have a computer, game and that says maximize your wealth, then I could just go and snatch somebody's purse. But that in the next sequence means that I actually have less than I started off with, most likely, right? But even though it works out short term.
Yeah. Do not pass go. Do not collect your $200. Go directly to jail.
Yeah, no, that's so there is that trial and error aspect to it, right? That's kind of also what you're touching on.
There is that too. Yeah. I mean, the way I
Mm.
sometimes explain this when I teach it is, imagine you go to a new restaurant you've never been to before. You have no idea what's good there, and so your first trip to the restaurant, you might essentially pick something by at random. But if you keep going back to that restaurant, at some point you'll kind of converge into a most of the time pick something that you know is one of your favorites, and then every now and then, if you're feeling adventurous, still try one of the things you haven't tried, at more or less at random again. Reinforcement learning systems have to do that because they start out with typically with no knowledge, right? They're not explicitly model based typically, so they start off like literally the person who's never been to the restaurant before.
And that's when the supervised versus not comes in, right? It's not deterministic. It's not like it's more like a mystery than a puzzle. There's no preset answer necessarily.
I think of supervised learning as as learning a specific function.
Mhm.
Essentially, supervised learning problems typically take the form of y equals f of x, and we have a bunch of data for x's and y's, but we don't know the function. I mean, that's a very important problem, but it also lacks the it's basically you can tack onto that an action space, and then tack onto that this notion that there's a different reward in every time period, and you want to maximize a long-term version of that. And so every reinforcement learning system has a supervised learning system built in. Sometimes several, right? Sometimes there's one supervised learning system that kind of represents the agent, and another one that kind of represents a critic or something that evaluates the agent's decisions, and those two processes interact. But right, it's important to realize that like those actors and critics are in modern implementations, they're deep neural nets, and a deep neural net is an example of a supervised learning system.
So maybe I'll ask you, Petter. I thought maybe in this context it would be cool to introduce this deterministic versus stochastic policies. So policy, right, is the recipe of how you should react to things that come your way as a reinforcement learning agent. What do we mean by that? Why might that be interesting for our audience to learn about?
Yeah, so a reinforcement learning agent makes a decision at a point in time, given the state of the environment, right? What it has observed up until that point. Now, if exactly that same state would reoccur again in the future, and it spits out exactly the same action, that's an example of a deterministic reinforcement learning agent, deterministic policy. Uh, but in some cases, it might also be beneficial to randomize the policy a little bit, right? So we think about probabilistic or non-deterministic policies. Some problems lend themselves. Financial problems are probabilistic in nature. There's often not just one answer. It's probabilistic in nature. Also, when I'm making trading decisions, for example, I may not want to repeat myself because that's going to create a pattern in the markets that others can pick up on. So that's the difference between deterministic and non-deterministic.
And is it fair to say that basically in real life it's similar to, I did this last time when I came in the situation and it worked out well enough. So it's kind of this exploration aspect to it that, well, what if it could work out even better? Because you can always go back to the prior line of action if it wasn't any better what you tried out, like in that stochastic kind of fashion.
It's somewhat related, but also somewhat different. So when we think about
Mm.
exploitation and exploration, that's more on the learning or the training side of reinforcement learning, which of course could be continuous, right? I could continuously update as new data comes in. As I am living through the environment, I could be updating my reinforcement learning agent. The deterministic nature versus the non-deterministic nature is a design that we make when we create these types of algorithms. Do we want to have perfectly predictable behavior? Do we want to have something that same state occurs the same again, we do the same thing, or should there be a bit of randomization around that? That can be for different reasons, right? As I mentioned before, one could be that I don't want to become detectable as part of the trading book.
So another topic on this, which I think is also easy to kind of mix up, but because it's kind of related, is the notion of the model-free versus model-based reinforcement learning. That also sounds like something that it's more like model-based, sounds more supervised, that is more like a function, but you can probably explain it better.
So, typically, for the entire history of financial engineering, up until the really recent period, I would say, we always had to build models. All derivative pricing was done via stochastic process models. And we knew the models weren't perfect, but we used them. And typically there was also a preference for models such as the Black-Scholes model, where you can derive a fully explicit formula that maybe gives you a convenient change of variables. Now in modern times, we could sort of suddenly have access to these extremely powerful tools. So then, what, if any, role is there still do the models have to play? And I think they still have many important roles. For one thing, reinforcement learning systems require a ton of training data. Typically, you're always looking at millions of training samples, even for relatively simple systems. And you wouldn't want to limit yourself to historical data anyway, because I think there's a sense among finance practitioners that the market data that we've seen is one possible history, and we think of that as a single sample from a random process, right? So if you replay the last n years that you're using to train these things, that if you just reset your time machine and replay the past again, you're going to get a different 20 years. And what we really want is models that are kind of robust to a lot of different scenarios, like things that haven't happened yet but perfectly well could happen. And now it isn't model-based reinforcement learning. It's just good practice and best practice to actually have as realistic a model as possible that is your training set generator. It's essentially not a useful and not a useful thing to try to do, to just train yourself purely on historical data, I would say, unless you have very high frequency data and a lot of it. And maybe that's an exception there, because that there you do have a huge corpus of training samples. Now, so I think everyone should essentially be doing model-based training. But model-based RL is also where we have a good model, but it's not complete, or we have a model for part of the system, and then the reinforcement learning agent has to figure out the rest. You could imagine, you could have two stochastic processes interact, and one of them interacts according to a known model, and the other one we just have no idea. We can build an RL system around that, where it essentially has to learn via experience the behavior of the unknown part of the state vector.
And so when we come to, so you brought up that simulating hypothetical, not just using historical data, is that then applicable mainly when we're talking about model-based, in terms of like what you put into the model?
Yeah, they can be different things. I mean, so reinforcement learning can be applied with no model at all. But then the question is, then, well, where are you going to get enough training data to really use it? But it can also be applied, for example, where what the RL system is learning is, for example, a parameter in a model. And so, I mean, there is a model, but there's still a part of the system state that the reinforcement learning system has to understand and ultimately learn how to act, in an optimal way. I mean, a good analogy here is self-driving cars, right? So I hope that the self-driving car folks don't only use real interactions with traffic to train, right? I mean, they use a good simulator, and we should do that too in finance. But before any agent is deployed in the wild, it should both be trained and also tested in as realistic a simulator as possible.
So to understand in terms of I'm a finance practitioner and I'm going to do some reinforcement learning here and I'm going to apply either model free or model based, what will be maybe if we give an example of what will be a good example of a model free project for finance analysis that I'm trying to do with financial application?
I wouldn't quite think about it like that. We typically, when we do financial modeling, we typically don't start from scratch, right? We do typically have already some existing framework. Or if we are developing a new class of models, we typically start by building some simple benchmark, right? And as we are going through model iterations and improving upon our modeling framework, we are going to compare that to to benchmark 0.5, and then we have a new benchmark 0.1 or 1.0 rather, 2.0, so on and so forth. So it becomes an exploration as we're building models. Now, if we want to be completely free of any assumptions whatsoever, we might take on a completely model-free reinforcement learning framework, and it's sort of using this very very broad, very general tool. Okay, but as Gordon was alluding to, self-driving cars, for example, to build such a system, there's a bunch of different subsystems, and some of those may be separate agents. Some of those might be very well known. If it's dark outside, I'm going to turn on the lights, right? I don't need to train an agent to turn on the lights when it becomes dark. And the same thing applies to finance. So in the context of managing a portfolio, for example, right? Typically we think about that as we have forecasts for return and risk. We have some way in which we're building portfolios. We have some way in which we are trading these portfolios, right? We have new trades that are generated, and we measure the risk, and then it repeats itself. So we have separate ways of forecasting that might be independent from the reinforcement learning agent. The reinforcement learning agent receives those as inputs. In terms of certain decision-making processes, we may have a good idea of, in a market where there are no frictions, how I would trade off return versus risk, right? So if there were no frictions in the markets, here's the way, the optimal portfolio that I would hold. So I may bring in that aspect into the model. I may supply the reinforcement learning agent with that information, and it now needs to learn the missing pieces, right? The part that that's maybe harder to model, the parts that could also be non-stationary through time and could change through time, right? There's a number of use cases that go along those lines.
So, for example, here you could have a lot of our listeners will be familiar with like a Markowitz frontier. So you have, I'm trying to get a good portfolio here, allocation, and I am weighing here the fact that if I increase my expected returns, I'm also going to increase my expected risk. So that's a pretty clear model. But then that model maybe become an input because I know that I care about other things, like you say, frictions, meaning maybe trade execution that comes into this, where this Markowitz model becomes part of it, but the rest may be model free, so to speak. Is that fair to say? So it becomes kind of spectrum, like you have components that are models into kind of a model free context?
Sure. Well, one way of thinking about it, right, is that for the Markowitz models, they're inputs. So when we calculate the weights that we then later use to produce the efficient frontier, well, the inputs are the expected returns and a risk model, typically the covariance matrix, right? And then also have some kind of risk aversion. And the simple solution to that problem, if it's unconstrained, is multiplying the inverse of the covariance matrix with the expected returns. Now, in the real world, when there are frictions, those portfolio holdings that I obtain from such a simple optimization are probably not going to be the ones that I'm going to trade because they're frictions. However, I may still have the same view on the expected returns, and I may have same view about the covariances or the correlations between assets. But now I want to bring in frictions, for example, and one way of doing that, which practitioners have done for many years, right, is to build transaction cost models, or what people now more popularly call price impact models. Uh, but now I perhaps could learn certain aspects of these price impact models. Price impact models are often relatively stylized, and they may not always take all the different state variables into account, right? They may not be able to see that we are in a different regime today than we were last week.
So it sounds like we're talking now very focused on model-based reinforcement learning, right? Maybe like what would be a stark example of a model free so that we get a sense of that too on the other side?
Yeah, I think I can talk about that. For example, when we first did this for option hedging, initially there was kind of a strong focus. Like the world had not yet bought into the idea that reinforcement learning was a great tool. Certainly, the financial world had not yet kind of fully bought into this. Of course, Anthropic and OpenAI knew it, but they were kind of in stealth mode at the time. And so one of our initial focuses in our research was essentially just to show that the systems can learn on their own with essentially no help, no hand-holding. They can pretty much learn some part of what we teach MBA students in business schools about option hedging, right? So the basic thing you learn about option hedging in business school is delta, and the Greeks can be used to derive hedge ratios for options. And we wanted to see that it could learn that on its own. And so all we told it was essentially that, a volatile P&L that arises due to the fact that you don't have a perfect hedge is bad. And so try not to have volatile P&L arising from mishedging. But anything involving the Greeks or delta hedging, we didn't tell it any of that. It had to figure it out. Of course, it didn't figure it out by deriving the Black-Scholes model. It figures it out from a ton of data, right? So we then proved that it can figure that out. Now, is that what you would do in practice in a state-of-the-art system that you want to work as well as you possibly could? No, I mean, actually, in a state-of-the-art system where, let's say it's being applied for real hedging, you want to give it every chance you possibly can. So I would tell it, for example, in the state vector, I would tell it every Greek we know how to calculate, where the Greeks are essentially partial derivatives of option pricing formulas. I would give it every exposure that we know, and then let it figure out the one remaining missing piece, which is still, well, what is the optimal hedge in the presence of transaction costs and a finite expiration time?
And I should clarify, maybe we're talking about the Greeks. We're not talking about the Greek people here. We are talking about the fact that if you have a price curve, depending on something else, there's a slope, and there's also the convexity versus concavity. And with an option, that becomes very important, of course, with the underlying, the price of the underlying asset and the price of the option as a result. I'm thinking maybe a good example of also an application that either of you can cover. You talk about trade execution. Maybe that's also a good illustration, how we use reinforcement learning for that. What kind of reinforcement learning are we using that as a stylized example?
The examples that you typically see today is people apply, in a similar way to what we did to options, to show that model-free reinforcement learning agents can learn to do trade execution under different assumptions of the markets, right? So just by extracting directly market data to let it figure out what the optimal policy is. Now, this is perhaps easier said than done because markets are very, very noisy, and extracting out this behavior requires a tremendous amount of data, which brings us into this whole aspect of using simulators and train on simulators. But on the trade execution problem, it allows me to learn behavior that I otherwise would not capture using traditional techniques, right? That relies on me obtaining some closed form or semi-closed form of some stochastic differential equation or HJB type of equation.
And we should clarify probably, like when we're talking about reinforcement learning generally, and correct me if this is wrong, um, at least if you have nothing else, there's always a goal, right? If you do trade execution, for example, you have to instruct it to like, what is the point of trade execution? Getting a good price on your trade often, while being able to execute it within a certain amount of time. So I guess there's always a trade-off between the goals in,
Yeah.
let's say if we take that example, but then maybe the rest, like then after that, like we were talking about, you might have a model, you might give it more guidance or you may not. It's just, but you have to at least give it some kind of goal, right?
Yes. Yes. So this is a good time maybe to talk a little bit about a little deeper in terms of how the training actually works, right? We talked about that we are observing data and we're letting the reinforcement learning agent figure out what is optimal to do, right? It's going to learn through that behavior, but we need to tell it what optimal means, right? And this is where this aspect of reward comes into play. And rewards typically in finance are going to be something financially measurable, right? We care about P&L, but maybe and P&L could be risk adjusted, right? And P&L may contain transaction costs. So it could be cumulative P&L over time, risk adjusted P&L over time, where we also take those transaction costs into account. So in the context of a trade execution problem, what is it that we care about? It's typically the horizon over which we are trading. We typically also care about the speed of trading. There's a notion of having some aversion of getting rid of a position faster, or maybe I can take a little bit more time. So in my reward function, when we do what people often refer to as engineering or building or defining the reward function, those are considerations that go into its design.
So as Petter mentioned, we typically care about reward and risk in all of these models. That's something that a broad class of these models have in common, including execution. We want to typically the goal is, if you could, to execute at arrival price. I mean, the arrival price is the price, it's usually a midpoint price when the order arrives. And typically the originator of the order, accesses that price, and they're aware of it, and when they made the decision to execute in the first place. So there's an assumption that the arrival price is somehow good, and then the stock price evolves in a stochastic process, which then implies that the longer you take to finish the execution, the more time you have to be subjected to those random moves, and hence the greater the risk you have of not achieving the arrival price in either direction. And there's nothing you can do about that. So then there's a trade-off between trading more quickly and paying more, realizing more market impact, and hence a worse price purely due to the impact, versus trading more slowly. You sometimes hear the terminology front-loaded versus back-loaded trading paths. So trading more slowly then exposes you to the underlying stochastic process for longer, and adds risk. And so essentially, going back to Almgren, Chris, and Grinnell and Kahn, we have a framework for understanding that, where it's essentially mean variance optimization, a lot like the Markowitz optimization you mentioned earlier, except mean variance over time. It turns out, under very general assumptions, that's equivalent to utility maximization, which is sort of the workhorse of modern economics.
So I think on a basic level, when people talk about, if we think about rewards, like when you have explicit rewards in your life, like if you have a dog, right? It's like reward is you get, your treat, right? And it's kind of similar here because we're saying, well, it could be model free or with a model. If you're a model, I'm telling you, press this button, you get the reward. If it's model free, you just don't know. Like, just do random things, look cute, roll around, see at some point I'm gonna get the reward. And with the trading, it almost feels like it's this thing about like you never know if you're if the human is going to end up stepping inside, so you kind of want to get it fast, but then better you do it, the more likely is it to be bigger rather than smaller too. So that's the trade-off, right? And you have to
Right.
give it kind of that trade-off at some point.
Uh, yes, I mean the reward is wealth, but it never comes down to just maximizing wealth, does it?
Mhm.
Right? I mean,
Right.
going back to Markowitz and even before that, investors have a utility function of wealth, and as we all know, in portfolio optimization, for example, if you optimize expected return alone, full stop, it ends up essentially putting all of the weight into the stock with the highest expected return, and it, is just a very bad solution. So reinforcement learning systems are exactly the same way. I mean, you have to tell it, as Petter said, what constitutes optimal. What constitutes optimal is never just the wealth alone, which is actually why we prefer to use the term reward there. Reward is not wealth alone. Reward is wealth achieved with low risk, or wealth achieved in accordance with the investor's utility function.
Where time should be an aspect too, right? Like often when we talk about maximize beat the market, it's often never defined over what time frame. And if it's a study, people impose, say, a year or something like that. But in real human life, I can care about shorter time frame, whereas you care about a longer time frame. So it seems defining the horizon is also very important, should be an important aspect of this exercise.
Oh, absolutely. Reinforcement learning systems have always kind of grappled with this. I mean, the typical framework and the most convenient mathematically is to imagine that time continues to infinity, but that we care less and less about the further and further future. And that leads to like a very nice, clean, well-defined mathematical framework in which the infinite sums are always well-defined because of the discounting of rewards in the long future. That also more or less corresponds with how people tend to think of utility and how it relates to future horizons. Now, on the other hand, a lot of the problems that we've been speaking about today, option hedging and optimal execution problems, they have a defined horizon built in. An option expires. A meta order to be executed is often over a day, or at finer horizons, it's given a lifetime of some sort over which either the execution is finished or canceled. And reinforcement learning has a separate framework to deal with those. Those are called episodic problems. And there's actually been a ton of research on episodic problems because the games that are sometimes used as testing grounds for reinforcement learning, such as chess, Go, Atari games. I mean, those are also episodes. Like you get to the end of the game and you've either won or achieved some score, but the game is over. It might be an interesting point to mention that one of the things that really put reinforcement learning on the map for ordinary people was when it was essentially AlphaGo Zero. Reinforcement learning produced the best Go player in the world, which had often been held out as a kind of a example that AI wasn't really intelligent yet because yes, like computers with a ton of rules like Deep Blue beat Garry Kasparov in chess, but Go is a much higher dimensional problem, and it was people always said, oh, that requires real strategic thinking. That's why humans are still better at it, and until they weren't. Also, the famous paper from about 10 years ago on superhuman performance in Atari games was reinforcement learning. Those are all episodic problems, just like the optimal execution and optimal hedging problems that have expiration dates.
People listening to this who are in finance, and they're taking away from this conversation that this reinforcement learning, that sounds interesting. I do a lot of portfolio optimization. Is that something that you would, how would you recommend, or what questions would you ask somebody to figure out the answer to? I do portfolio optimization. Should I be using reinforcement learning? Tell me.
I think a good starting point is to read a little bit more about it, and the chapter that we put together here for the CFN Institute, I think is a good starting point. It will give you an idea a little bit of the pros and cons of the of the framework, and check out some of the other chapters in that book as well, because there's a lot of information about machine learning tools and techniques there. Now, when it comes to applying reinforcement learning, I think one of the underlying themes here, we talked about aspects of it, right? We talked about model free, model based, so on and so forth, is that it's a very, very general tool. And of course, it could be applied to, in principle, to solve any sequential decision making problem. And portfolio optimization and trading is one such example. Typically, we're not going to have enough data to train such general systems on very large portfolios that are trading, say, thousands of stocks globally. We typically don't have enough data. And we often are, most people probably would also agree that it's very hard to build good simulators for data of that kind. So leveraging reinforcement learning today is often, as I think Gordon was alluding to earlier, is to learn certain aspects of our models that we don't want to constrain with previous knowledge, where we're letting the data speak, right, if you wish, and learning those specific aspects. I'm sorry. That is probably the best way today to lever reinforcement learning for a portfolio manager.
Yeah, no, that's great. And to your point, we're covering the very basic overview here. There's so much to learn, and it was so really interesting to read the chapter. So definitely recommend people start there. But of course, as you listen to this, you should also start by listening to our next conversation. Look out for it if it hasn't come out yet. But we will, in the next conversation, also cover the inverse reinforcement learning, which is something I had not heard of before. So there's going to be a lot of new things to learn for all our listeners there. So we will see you in that next episode. Thank you so much, Petter Kolm and Gordon Ritter, for being with us today. And thank you, everyone, for tuning in to the Financial Thought Exchange podcast. As I mentioned, Petter Kolm and Gordon Ritter were my guests here. They're both co-authors together with Igor Halperin of the Reinforcement Learning and Inverse Reinforcement Learning chapter, which is part of our publication AI in Asset Management. So I recommend you reading that, and we will see you again soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.